We did not anticipate that the Treasury yields would fall tremendously in this month.
US Treasuries would go high, US inflation would be significantly higher, and US data would be very, very strong.
What about US? Do you still see US going for a rate cut?
We have seen US CPI to be stable. In fact, growth has started to weaken, and which has led to the expectation of rate cuts being built in again.
Hi all, welcome to this month's Fixed Income Outlook by Axis Mutual Fund. I'm Shalini Gautam. Today we have with us Devang Shah, Head Fixed Income. Devang is going to talk to us today about how the markets look in fixed income globally and in India. So Devang, what do you think? What have been the key developments in the last 1 month or the last 2 months?
Thank you, Shalini. To start with, I think probably first February was a month of significant events for fixed income markets. We had the monetary policy coming out and there was a rate cut. There were a lot of liquidity measures which got announced in the month of February. RBI took a lot of measures starting January actually, and they have infused close to 3 lakh crores plus of liquidity. So the most important factor, if you ask me, is the acknowledgement of the fact by the central banker that somewhere down the line India growth is slowing. And secondly, we need to address the liquidity side. So I think probably they have taken measures on both sides. To address the growth, they have given a rate cut. And to address the liquidity scenario, they have done a slew of liquidity measures like OMO purchases, FX buy-sell, swap facility, as well as VRR. Totally, they have infused 3 lakh crores of liquidity. Along with the policy, we also had the budget. The budget was for fixed income markets, I would say in line with expectations. Specifically, fixed income markets looked at gross borrowing and net borrowing. Both came in line with market expectations. Other two factors which impacted bond markets for the month of February were the release of CPI and GDP data. Yeah. I would take a couple of minutes to explain what happened on the GDP side. The growth numbers came better than the Q2. The Q3 print was higher than as expected. I think market were expecting close to 6%. We got a GDP of 6.2. If you look at the CPI also, the CPI came a tad lower than market expectations. So if you, from a perspective of the macro dynamics and the macro data which got released for the month of February, I think growth slightly surprised us positively, as well as on the inflation side, I think core continues to behave well, and specifically headline inflation this month and the near-term prints looks lower. So for a bond market, I think the month was quite positive, and we have actually seen yields lower by around 3 to 5 basis across the curve.
So that was about the domestic markets, but we have seen a lot of action on the global front. We did not anticipate that the Treasury yields would fall tremendously in this month. What is your take on the markets globally?
So you're right, you're perfectly summed it quite well. As against expectation, the yields actually on US Treasuries are lower month on month by more than 40 to 50 odd basis. Last month at the same point of time, we were at 460. Currently, we are trading at close to 420 on US Treasuries. What's the reason behind this? It is important to assess that I think two important things which came across on US markets which led to this rally in bond markets on global yields. One was the US data. The US data has come out to be quite mixed. I think somewhere down the line, if you look across at the growth data is slowing. Retail sales, specifically home data, and you also look across at the CPI numbers. The CPI numbers have actually come lower than what market expectations were. Secondly, the other important reason is that Fed in its minutes spoke about the end of balance sheet reduction. So somewhere down the line, there was a lot of balance sheet reduction which was happening. They were reducing treasuries or additional supply of 40 billion plus per month on account of balance sheet reduction. I think probably June onwards or probably next meeting onwards, we might see the balance sheet reduction to end. And that led to the rally in bond markets. If you look across, they have been quite gradual. They've started with tariffs. Yes, they did impose additional 10% tariffs on China. But I think the fear psychosis which was built up on markets about US Treasuries would go high, US inflation would be significantly higher, and US data would be very, very strong. I think to the contrary, we have seen US CPI to be stable. In fact, growth has started to weaken, and which has led to the expectation of rate cuts being built in again, which has led to the rally in bond markets for US.
So that was the backdrop of India and globally.
Right.
Now, against this backdrop, what do you think is the outlook for the markets in India and the US, and where do you think the rate cycle is headed?
See, if you ask me, I think if you look across the local macro, what a central banker would think, and specifically if we are looking at India macro, GDP continues to remain on the softer side. It is better than expected, yes. 6.2 is not a bad number. Again, Q4 GDP might come closer to 6.5%. So GDP is okay, but it is significantly lower than what RBI and government were initially projecting. Secondly, I think CPI is well under control. If you ask me, the near term, the next 6 months expectation for us on inflation is that inflation would be closer to 4.25%. With that backdrop and the currency stabilizing at closer to 87 levels, I think at this point of time we are too positive on the fixed income markets, and we are guiding investors that we can expect another 25 to 50 basis of rate cuts in the next 6 to 12 months. My personal take is we will see a 25 basis rate cut in April and probably have a longer pause after that. But if growth data disappoints significantly, or if we see a faster US rate cut trajectory, then probably we might see additional 25 basis of rate cuts totaling to 50 basis of rate cut. With that context, I think the fixed income markets look good at this point of time.
So that was about India, but what about US? Do you still see US going for a rate cut?
Our view has been, so in fact, markets have actually significantly changed their view in the last 18 months. There were 0 rate cuts and 100 rate cuts, and now again for the year of, if you have looked at in January, early this year, I think markets were not pricing in even a single rate cut. Again, if you look at today, markets are pricing in 75 basis of rate cuts. Our view has been that we would see 50 to 75 basis of rate cuts in this year from Fed also. So probably from a 4/4, 4/2 on Fed levels, we will probably move closer to 3/2. That's our view on Fed rate cuts.
But if you're talking about inflationary policies in the US and a Fed rate cut, how does this tie in together?
So our perspective is, first of all, Trump will be significantly slower in implementation of its policies. Our perspective is that yes, he will use somewhere down the line all the negotiation tools, and somewhere down the line it will help US from a macro perspective. Secondly, they have been focusing on lowering inflation. If you look across at the biggest driver for inflation has always been oil prices. Oil prices have started to collapse, and there has been talks about OPEC increasing the supply. So our view going ahead is that probably we should not get too worried about inflation. US inflation would settle closer to 2.5 to 3%, and that is why US rates should in the medium term settle closer to 3.5. Even with 3.5 Fed fund rate, we are talking about a 75 to 100 basis of rate cuts, and that is why we believe this year we should see some rate cuts.
So now that was all about the backdrop and the markets. What is it in it for the investors? How should they look at investing in fixed income funds?
Our context at this point of time is that with the backdrop of monetary policy, where we anticipate a 25 basis rate cut in April, plus all the liquidity measures which RBI has taken, closer to 3 lakh crores, we believe at this point of time that investors should be significantly building up on their debt portfolios. Short to medium term funds and gilt funds for tactical allocations makes a lot of sense for investors at this point of time. Okay. So that's the advice to our clients.
So thank you, Devang, so much for your valuable inputs. And thank you all for joining us for this month's Outlook. See you next month.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.